We continue to be at historically high valuations, which greatly increases the likelihood of a crash. But the question everybody wants to know is, when will a crash occur? According to Warren Buffett, the single most reliable metric of stock valuations at any given time is the stock market to GDP ratio. What that does is it takes the entire stock market cap, divides it by the GDP, and gives that sort of metric. And it makes sense because as GDP grows, as the country's income grows, then the stock market should probably go along with it. Now, what I did was I created my stock market to GDP ratio, but I just did it as a ratio of the S&P 500 because really, it's going to all go in tandem. And I had data on the S&P 500 or its equivalents going back to 1928. And guys, here it is. We are currently at a ratio of 2.02. which is 114% overvalued. Not 114% of normal value, 114% overvalued, giving the fair market value of 2,700 on the S&P, which is significantly lower than we are today. Now, you might sit there and say, well, then why should I buy? That's the most common question I get. Paul, if we're at major overvaluation metrics, why should I buy? You teach a process on your main channel of buying individual stocks. Yes, I do. And remember, we don't know when markets are going to bottom. We don't know where they're going to top. If you look at time since COVID, we've been overvalued for quite some time now. The entire time, even after the COVID crash, we were still 35% overvalued based on this metric. But guess what? We just continue to climb and climb and climb and climb and climb. And fair value keeps getting higher and higher and higher. Our job as investors is to do one of two things. Actually, even possibly both things. One, dollar cost average into low cost ETFs, take the guessing game out of it. And two, if you choose to buy individual stocks, pick stocks that make sense today at current valuations. And if stocks fall, you have the opportunity of buying more. That's what makes investing so great. Take out the thinking about when should I get in, when should I get out. Trust me, I've fallen for the exact same traps. Now, some people also criticize this metric saying, well, Paul, it doesn't factor in money earned overseas by companies, blah, 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 blah. Okay, so let's go to the 10-year cyclically adjusted PE ratio. What this does is it takes the last 10 years of earnings on the S&P, no matter where it was earned, brings it to today in today's dollars, and does a PE ratio for it. We're currently at 37. Historical average is 17.1. We're 117% overvalued based on this metric. Now, this is not as correlated with future returns as the other one, but it still goes to show we're still at a very high level. And guys, the interesting part is you can get 4.5% on a 90-day treasury. I could have somewhat understood these metrics saying, hey, 0% interest, you got to get your return somewhere. But we can get 4.5% at a 90-day treasury. So why pay a 3% earnings yield is what you're paying, actually less than that, 2.8% at 37 PE. Now, this might sound scary. You might sit there and go, oh my gosh, market's going to crash. Maybe they will. But remember, look at what's impressive here. As inflation kicked up, look at our fair value. We were at 1850 back in June of 2020, and it's just kept climbing and climbing. Fair value has gone up 50%. 50% since COVID. Fair value. That's incredible. Now, guys, if you like what you're hearing here, I'm not trying to be a fudster. What I'm trying to teach here is a process of understanding money and embracing bad markets. Because Morgan Housel always says, every past crash looks like the opportunity of a lifetime. Every future one looks like a risk. I want to change that future look for people out there because I used to feel the same way. And a part of me still does today. It is scary to think markets go down 50%. I have stocks, I have ETFs, and I'm looking at it going, man, I would hate to see my money fall. But if you understand it, in the whole overall grand scheme of things, it's a reassuring area. So if you like what you're hearing here and you want to learn more and have this repeated over and over because it takes time and repetition, do me a favor, subscribe to the channel. So when will the crash occur? I have no idea. And anybody who says otherwise is lying to you. They might get it right here or there. There's a woman who predicted the 1987 stock market crash, and ever since there, she missed everything from there on out. The best investors are the ones that dollar cost average into ETFs, and if they choose to buy individual companies, pick solid companies that have improving fundamentals even when prices fall. That is the best way to invest. You'll do better in life, and if you embrace that, you'll sleep better, and that's what's most important. Now, this week is an exciting week for earnings. Guys, let me show you what we have on the slate for earnings this week. Look at all of this. Big companies. 3M, a company I own, currently has earnings tomorrow. But remember, don't buy any company because somebody on the internet talks about it or owns it themselves. The job we're trying to do on this channel is to teach a process, but you can apply that process to your own investments. Dalton is one of our in-house analysts. What I love about Dalton is he loves companies that I would never, ever touch. But if you look at our process, it's the same way of thinking. That's what's most important here. Other companies, Coca-Cola, AT&T, Boeing. Boeing just settled their union strike, and they're going to get back to work here. But guys, look at this one, Tesla. Tesla's a company we talk about a lot. Why? Because its all-time high was 415, got as low as 100. It's currently in the low to mid 200s, and guess what? Their fundamentals, since being at 414, 100% increase in revenue, 100% plus increase in profit. And the stock is down a lot. So what does it mean? In the short run, stocks are a voting machine. In the long run, they are a weighing machine. Some other companies to look at, Southwest, another company I own. Now, guys, even though companies are reporting, with a company like Southwest, their profit margin has been bad for the last 5 years. My bet on them is that they get back to profit margins previously. I don't care what each individual company reports in any given quarter. What I care about is what's the long-term trend. I want to sit there and see, is Southwest getting back to better free cash flow and net income profit margins? That's what matters to me. Now, you might sit there and say, wait, you don't care about quarter to quarter? I don't. My goal is to buy good companies at great prices. And when I do that, if I'm able to do that in the long run, great management teams, great companies will keep driving up their revenue and profit. And sometimes they might miss. They can't control that. In fact, any company that beats every single time for 20 or 30 years, got to start asking questions at that point. Even the best companies will not beat every single time. I want to sit there and say, are their fundamentals improving? Look at 3M. 3M is one of the best performers this year in the Dow. But this is a company that had major lawsuits that they had to handle. They had to handle all these things last year. It really drove down their income. And guys, it's an everything company. They make everything out there, but they got some issues there with with declining sales. But they have declining sales with increasing profit margin, increasing free cash flow. Those are some interesting things. The question is, are they just cutting expenses and sacrificing from the future to get good results today? That's the question you have to ask yourself. So guys, again, if you want to see 3 or 4 or 5 videos a week on earnings releases, news in the market, mentality type of thinking, do me a favor. Subscribe to the channel. And a very relevant video, click on our next video. Should you wait for the S&P 500 to crash before you start buying? Thank you for your time.